the WTO's Global Trade Outlook and Statistics Report. I'm Ismail Ejeng. I'm the Director of Information and External Relations here at the WTO. Joining me today, Ralph Ossa, our Chief Economist to my left, Cole Madney, our Senior Economist to my right, Barbara D'Andrea Adrian, who's a Senior Statistician, and Jose Antonio Montero, who's also a Research Economist in the Economic Research and Statistics Division here. The report, as Dan said, is under embargo until 3 p.m. and then the embargo will lift and then you can report on it. In terms of the format of this press conference, Ralph will start with some short opening remarks outlining the key points of the report. Then Coleman will discuss the 2023 data and regional trends, and Barbara will share highlights on trades and services. Then we'll open it up to questions. We have roughly 1 hour. So without further ado, I will hand over to Ralph for his opening remarks. Ralph.
Yeah, thank you very much, Ismaila, and good afternoon, everyone. Thank you very much for coming or for joining us online. We're very happy today to release our Global Trade Outlook and Statistics report for April 2024. It's in its second year, and the report has been expanded to include a wider array of statistical data and analysis. For example, we've added a new analytical section dealing with a specific trade issue, in this case, the Red Sea crisis. We intend to make this kind of analysis a regular feature of these reports going forward. Turning to the forecast, we expect a gradual recovery in world merchandise trade volume in 2024 and 2025 after a contraction in 2023 that was driven mostly by the lingering effects of high energy prices and inflation in advanced economies, particularly in Europe. Specifically, we expect merchandise trade to grow by 2.6% in 2024 and 3.3% in 2025 after falling by 1.2% in 2023. However, the presence of numerous downside risks has added to the uncertainty that is inherent in all economic forecasts and especially trade forecasts. These include regional conflicts, geopolitical tensions, and economic policy uncertainty. In value terms, merchandise trade fell 5% in 2023 to $24.01 trillion, but the decline was mostly offset by a 9% increase in commercial services trade, which reached around $7.54 trillion. Total goods and services trade was only down 2%. While the trade environment is clearly challenging, we should not paint too dark a picture of international trade. As you can see from the chart on the left, and this is not the one that we should see. Yes. As you can see from the chart on the left, the volume of world merchandise trade was essentially flat throughout 2023. The 1.2% decline is really only relative to 2022. It was also up 6.3% compared to the pre-pandemic peak in the third quarter of 2019 and up 19.1% compared to 2015. So the big picture is really one of resilience in international trade. As you can see from the chart on the right, most of the trade volume decline between 2022 and 2023 was driven by Europe, which subtracted 1.7 percentage points from global import growth and reduced global export growth by 1.0 percentage points. Other industrialized regions also weighed on trade growth, but less so than Europe. Looking ahead, we expect all regions to make positive contributions to export and import growth in 2024. The chart highlights the particularly important role of Asia, the chart on the right that is, which is expected to add around 1.3 percentage points to global export growth and 1.9 percentage points to global import growth in 2024. Next slide, please. As you can see from the left panel, trade growth in 2023 was unusually weak compared to real GDP growth at market exchange rates, which only slowed to 2.7% in 2023 from 3.1% in 2022 and is expected to remain stable over the next 2 years at 2.6% in 2024 and 2.7% in 2025. We believe that inflation was an important driver of this. Higher prices depressed real household incomes and eroded net revenues of firms in 2023, reducing demand for manufactured goods, which feature disproportionately in international trade. Europe was hit especially hard by the rising costs of energy since the start of the war in Ukraine due to its dependence on imported natural gas. Conversely, the easing of inflationary pressures and eventual reductions in interest rates should have the opposite effect this year next, gradually lifting consumption and raising import demand. With that, let me hand over to my colleague Coleman Nee, who will provide additional details on the forecast. And I would also like to take this opportunity to thank Coleman, Barbara, Jose, and the entire team for the excellent work in producing this report. Thank you very much.
Thanks, Ralph. Thanks, Ismaila. I'll keep my remarks brief. I'd just like to draw your attention to some other aspects of the report and perhaps anticipate some of your questions. Many of you will have noticed that the 1.2% decline in world merchandise trade in 2023 represents a significant downgrade from the WTO's last forecast of October 2023, which predicted weak trade volume growth of 0.8%, but not a contraction. As Ralph mentioned, the trade decline was driven by weaker than expected trade in Europe, but projections for other regions were actually close to correct. For example, our October forecast predicted that North American exports would increase by 3.6%, while the final figure was 3.7%. On the import side, we anticipated a small decline of 1.2% for North America, not far from the actual 2.0% drop. As for Asia, we predicted a small 0.6% rise in exports and got a 0.1% increase instead. As for imports, we expected a 0.6% decline and got 0.4%. I will not go through every region, but even our forecasts for hard to predict resource exporting regions were close to the mark. The one big miss was Europe, where we anticipated a 0.4% growth in exports and 0.7% for imports. Minus 0.7% for imports. What we got instead was a 2.6% fall in exports and a large 4.7% drop in imports. This had a significant impact at the global level due to the outsized share of Europe in world trade, 37% on both the export and import sides. This includes our geographic definition of Europe, which is wider than the European Union. That includes. So there were several reasons for the large decline in Europe. The regional nature of natural gas markets means that Europe was subjected to a much larger energy price shock than the rest of the world. Prices have since receded from their peaks, but they remain high by historical standards, which has weighed on consumption and real incomes. One other issue that is alluded to in the report is data quality. Import prices used to calculate trade volumes may not be fully accounting for the large energy price fluctuations over the last 2 years. As a result, we see a large discrepancy between world export growth and world import growth, minus 0.6 on the export side versus minus 1.8 for imports. Whereas normally these differ by just usually a few percentage points, a few tenths of a percentage point, actually. Next slide, please. The relationship between world merchandise trade growth and world GDP growth at market exchange rates has not fundamentally changed. The ratio between the two has remained weak since the global financial crisis, averaging a little less than 1-to-1, compared to 1.5% to 1 in the early 2000s and more than 2-to-1 in the 1990s. One thing that has increased, though, is volatility. You can see that from the ratio is from 1 year to the next 1.5, 1.6, and then it drops to 0.4. But on average, it's still around 1. So next slide, please. Finally, I would like to draw your attention to the section of the report dealing with evidence of global value chain fragmentation. In this section, we document that bilateral trade between China and the United States grew 30% more slowly since 2018 than their trade with the rest of the world. Even so, bilateral trade in parts and components by region of major reporting countries, shown in the right panel above, has not changed much, suggesting that GVCs are evolving rather than collapsing. I would also recall that the published result from our 2023 World Trade Report and associated WTO staff working paper, which showed that there's been disproportionate growth among countries that have politically similar countries since the beginning of the war in Ukraine in 2022. We also discuss evidence of friendshoring in services and the high economic costs of possible digital fragmentation, specifically data flow policies. Thank you.
Thank you, Coleman. Barbara.
Thank you, Coleman, and thank you, Ismaila. Services trade continued to expand rapidly in 2023, and this despite the decline of transport, which dropped 8% globally. Negative transport growth reflects the return of shipping rates to pre-pandemic levels. The attacks on the Red Sea shipping have reversed this downward trend. However, the impact of these recent disruptions on freight rates is moderate compared with pandemic peaks, and this is due to low demand. By contrast, the difficult economic context and geopolitical tensions have not affected consumer spending on travel, and this is benefiting both passenger transport and tourism, two sectors which were ravaged by the pandemic. Travelers' expenditure in foreign countries was up 38% in 2023, as you can see in the chart, and 4% above 2019 levels. However, while some regions have completely recovered, Asia remained depressed, below pre-pandemic levels. But lower inflation in major sporting events in Europe in the summer and easing of visas requirements by various countries will boost tourism recovery in 2024. Other commercial services returned to robust growth in 2023, and this following subdued performance in 2022, which was largely due to exchange rates volatility. Financial services were really greatly affected in 2022, but as you can see in the chart, they were up 8% globally in 2023. Business, professional, and technical services saw a 10% rise. High growth of insurance services, a plus 17% in 2023, reflects the present risk environment, especially for businesses arising from geopolitical tensions, health hazards, supply chain disruptions, and increasingly climate change-related natural disasters, which affects premiums growth. Computer services expanded by 11%, with many economies, both advanced and emerging ones, recording annual growth exceeding 20 to 30%. So it's really impressive. And 2023, in fact, was the landmark year for artificial intelligence with generative AI models. And these technologies are set to revolutionize various aspects of the economy and further boost trade in digitally delivered services. Next slide, please. So according to our estimates, global exports of digitally delivered services reached $4.25 trillion in 2023, up 9% year on year, and accounting 13.8% of all exports of goods and services. Now, the value of these services that are meaning digitally delivered, so traded cross borders through computer networks and encompassing everything from professional services to streaming of music and videos and remote education, online gaming, they also surpassed pre-pandemic levels by over 50% in 2023. And unlike goods, as you can see in the right chart in the slide, which fell globally and in all regions, exports of digitally delivered services continue to thrive. Next slide, please. And in fact, the way services are traded internationally has changed over the years. The COVID pandemic has further accelerated services digitalization. And today we are pleased to release a new data set on trading services by modal supply. According to our estimates, services account for a much larger share of global trade than traditionally estimated, some 42% when we consider services supplied locally through branches and subsidiaries, and for a total value of $17.4 trillion in 2022, the latest available year. Next slide, please. But we are also pleased because we're also launching a global services trade data hub. And the hub gives access to comprehensive WTO services trade data. It provides visualizations and customizable features for download as it can cater to diverse needs of trade negotiators, analysts, researchers, and decision makers to derive valuable insights. The hub covers digitally delivered services trade, so not only export, but also imports, trading services by modal supply, trading commercial services, our first estimates for 2023, and the WTO OECD balance trading services data set. So I hope you will enjoy it and you start exploring the data. Our annual and quarterly data on merchandise and commercial services trade can also be downloaded from the WTO website in our WTO stats. However, we had a little technical issues, so the data will be available tomorrow. There was a technical issues overnight. So, but you can use the Excel files that are complementary to the report, and also start exploring the Global Trade Services app. Thank you.
Thank you very much, Barbara. Now I would like to open it up for questions. If you are joining online, please click the raise the hand button and wait until you are called on. I'll start with the room. Laurent.
Laurent Siro, Swiss News Agency. Thanks for the press conference. How do you get to that 3.3% for next year, starting from the prediction from this year? And how do you factor the electoral, if you can, the electoral volatility that we expect this year? For instance, Donald Trump has already announced that if he's elected, he's going to impose a 100% taxes on Chinese cars. So how is it possible to factor that kind of electoral volatility? Thank you.
Yeah, thank you very much for the question, and also thank you for coming. Let me maybe start with the second part of your question. It's not just the United States, but something like 50 countries this year have elections, which of course adds to policy uncertainty and also trade policy uncertainty. And as we mentioned, trade policy uncertainty in general is a risk to the outlook. What I sometimes say is that, the job of the WTO is not so different from the job of a central bank, because the central bank is not just about managing inflation, but it's also about managing inflation expectations. And for us, it's also not just about managing trade costs, but also managing about trade cost expectations. So of course, uncertainty is not what we like. And by the way, just in brackets, I mean, that's the whole point of having a rules-based trading system as opposed to a power-based trading system, is to reduce trade policy uncertainty, or at least an important point. The first point, how do we get to the 3.3%? So as you know, this year we're already projecting 2.6%, then next year 3.3%. That's mainly just as the adverse effects that we saw in 2023 start normalizing, and in particular Europe, you see this year is still growing. I mean, it's no longer going to be a drag on trade as far as we estimate, but next year is going to start actually also being a push, so contributing to world trade more strongly.
Thank you, Ralph.
Can I just join in? Just briefly?
Yes, please.
Sorry, just as a follow-up, our forecast does include a sort of an error range. It doesn't take into account explicitly political variables, which are really impossible to predict. But even with normal variation, trade growth could be as high as 5.8% next year, or I mean this year rather, or as low as -1.6. So trade in general is much more volatile, for instance, than global GDP growth.
Thank you, Coleman. Can we go online? I have a difficulty reading the names from here. Jackie Palmer? Yes, Jackie, please.
Well, this is Doug Palmer. I'm just going to guess that you meant me. I have a question about the digital delivered services and the growth that we're seeing there. I just wondered, there's a lot of concern about digital trade barriers and data localization requirements. Do you guys know, or does the report sort of address how much digitally delivered services account for total data flows? I mean, is it half, a quarter? Is there any way to put an estimate on that? And is there any sort of analysis about how much digital trade barriers are affecting the growth of digitally delivered services?
Well, thank you very much for the question. I'm not going to have a complete answer, but the report does speak to it to some extent. So, of course, digital trade is closely related to data flows. How closely we don't quantify in the report, but what we do show at the very end. So there's a short section on fragmentation and the risks related to fragmentation, and we refer to a study that is about to come out that looks at the potential economic costs of geoeconomic fragmentation on data flow restrictions. And what the study shows that we kind of sneak preview here in this report is that the worst case scenario, so if you had a fragmentation of data flow regulations along geopolitical lines, that could by itself depress global GDP by something like 1%. And I believe there's also an estimate for what it could do to exports, but I don't recall that now off the top of my head. I don't know, Barbara, if you want to add something.
Yeah, thank you. Thank you, Ralph, and thank you for this question. So, of course, here we are talking about the value of services that are traded through digital means. And so there is no specific measure of data flows as such, which are not covered by the definition of digital trade, the statistical definition of digital trade. But this high flows, of course, entail a high flow of data. So the data is embedded. And I think we can look at internet traffic, and we can see the first estimates that they flag for a 25% of global internet traffic in 2023, on the top of the previous increases of more than 30% over the previous years. So, thank you.
Thank you, Barbara. I have Maya Plants. Maya, please.
Thank you, Ismaila, for taking my question. My question is regarding the regional trade outlook. You mentioned that Africa, the Africa region is expected to see fastest growth in export in 2024. How did you arrive to these projections?
Yeah, thank you very much for the question. So it is true that if you look at the simply at the growth rates for 2024 that we're projecting, Africa looks very good, both on the exports as well as on the import dimension. But just to put this in context, if you want to look at chart number 8, you will also see that Africa hasn't been doing particularly well since the pandemic. So in some sense, that's also catching. So it's starting from a relatively low base. So just to put this in context, and how did we get to that conclusion? Well, our sense is that this is a variety of factors, and in particular, is also going to be related to the general recovery of international trade and to the general recovery of manufacturing in the world, which then will also generate demand for the kind of products that are exported by African economies.
Thank you, Ralph. I have now Chris Horstman. Chris.
Yes, hi. Thanks, Ismaila, for taking my question. Just wanted to come back to the what we were speaking about just now about the risks of fragmentation in digital growth and data flows and the risks to GDP of that that happening. Do you see this as being supportive of the idea that tariffs on trade in e-commerce should remain at zero rather than be reintroduced? I mean, is the evidence pointing in that direction? Would that be one of the downside risks that you see in this area? Thank you.
So let me maybe start by clarifying again what Barbara said, that data flows is of course not the same as digitally delivered services, and digitally delivered services, sorry, I always have a hard time pronouncing this word. Digitally delivered services is also not the same as the e-commerce that is covered by our e-commerce agreement, and in particular by the moratorium on customs duties on electronic transmissions. So you have to be a little bit careful there. What I also want to recall is that, of course, at MC13, one of the major outcomes was for our members to renew the moratorium at least for another 2 years. And we also have the plurilateral negotiations going, which would also address this issue, even though just on a, among a subgroup of countries. But having said this, of course, it's fair to say that if you have higher customs duties on electronic transmissions, that then you're going to have less electronic transmissions. I think that's an economic prediction one can comfortably make.
Thank you, Ralph. Matt Smith. Matt, you can come in, yes.
Hi, sorry, I was on mute. Hopefully you can hear me. I was just focusing on the Middle East, and I see that you forecast merchandise export volumes will increase 3.5% this year versus a 1.6% contraction last year. So I was just wondering if you could provide some insight as to the, why is there that kind of big shift? And also then similarly for imports, we're seeing you're forecasting a 1.2% growth in imports to the Middle East versus 9.8% growth last year. So just wondering if you could please provide some insights behind those figures.
Answer that. Thanks for your question. The Middle East is a region that exports oil and other petroleum products disproportionately. And demand for this tends to grow at a rather steady pace. So we had on average, so we had a bit of a dip in 2023 because of the slower than expected growth on the export side, and then we would expect sort of a rebound as exports return to previous trends. As for the import side, these by the way are exports and imports in volume terms, so in real terms. Because of the high energy prices that prevailed over the last couple of years, countries that export petroleum products were able to afford. They had large export revenues. So even though the quantity of Middle East exports wasn't growing that much, the dollar value of it rose significantly, and so that permitted these countries to import more goods in volume terms. And so after a rather surge of imports over the last couple of years, it should moderate in 2024. Thanks.
Thank you.
Thanks, Coleman. Alvin Cabral. Alvin, you can come in, please.
Oh, can you hear me?
Yes, we can.
Yeah, hi, Alvin Cabral from the National News in Abu Dhabi. Thank you for the press conference. I would like to know how will trade in the Middle East be affected if the Israel-Gaza war becomes prolonged? Thank you.
So maybe I can speak more broadly about the effect of the crisis in the Middle East on international trade, and then perhaps some of my colleagues want to jump in and discuss specifically the effect on trade in the Middle East. But one thing that we see so far, particularly with respect to the tensions in the Red Sea, that of course directly affect international trade because they directly affect the passage through the Suez Canal. It does, of course, have an effect on trade, and that's not surprising given that the Suez Canal is an important trade route. About 1/3 of container traffic between Asia and Europe go through the Suez Canal. I think something like 12% of global trade. And of course, this is going to have an impact on international trade, particularly between Asia and Europe. However, so far, at least, it is our impression that our analysis suggests that this trade effect is not so severe. And for it to become really severe, I think what would have to happen is the crisis would have to escalate and really start to affect energy markets. So we would have to see, price spikes in oil and so on for this to unfold. I don't know, Jose, if you want to add something. No? Okay.
Thank you, Ralph. I have a written question that we have received. It's from La Vanguardia. It says the data indicate that trade is growing less than world GDP, when years ago it was double. In 2023, it was even negative, if I'm not mistaken. Has it happened in other times in history?
Well, yes, we did have previous instances where trade fell, and also trade fell faster than GDP. I think, Coleman, we even looked this up, right? Yeah. So you might remember.
Yeah, I do recall. Trade growth was negative in 2020 during the pandemic. In 2009, in the aftermath of the global financial crisis, it was very slightly negative in 2001, although that seems to have been revised away. Now it's zero. And then also in 81, 82, there was sort of a double dip global recession during those years. And finally in 75. A number of these were energy price related. So 1975 was an oil shock. 81, 82 was the same thing. And also there's sort of an energy shock related to the invasion of Ukraine.
So just to clarify that, I think what Coleman was talking about was negative trade growth. You asked about trade to GDP, so I think we would have to look this up specifically. But let me just make sure we get the big picture message right, which I think is important. So in terms of the big picture, we saw trade grow about twice as fast as GDP in the 1990s. Then in the early 2000s, it grew about 1.5 times as fast. And now it's about 1-to-1. Coleman said this already in his presentation, but it's, I think, a really important point. So we don't see any deglobalization. So far, trade is being resilient, which I think is actually quite remarkable given the shocks that international trade has been facing. Think about the pandemic, think about the geopolitical tensions, regional conflicts, high inflation, contractionary monetary policy, limited fiscal space, and so on. So I just wanted to highlight this.
If I may just clarify, the years when there was negative trade growth, except for 2009, that implied a negative trade growth to GDP growth because 2009 was the only year since the Second World War where global GDP contracted. And then you had a positive ratio, but it was two negative numbers.
Thanks, Coleman. I have a follow-up question on the same topic, actually, from Angela Howe from SINA France. What should be the ideal scenario of the growth rate between merchandise trade and GDP growth? Which should go faster than the other? That's for you, Ralph.
I mean, ideal growth rate, I don't know. I mean, what I can say based on just economic theory is that, if trade costs don't fall, then trade and GDP should grow more or less 1-to-1. So having trade grow more or less 1-to-1 with GDP as such is not something that I find particularly concerning. Now, when I think about kind of the medium run, though, our colleagues at the IMF, at the World Bank, they're starting to talk about a growth slowdown. And of course, and that's a GDP growth slowdown. And of course, what we would like to see, as we would like to see that trade can be reinvigorated as an engine of growth that kind of supports this, because we still have a lot to achieve. I mean, just think about the Sustainable Development Goals, for example. That's just not going to happen without robust economic growth. And if you want that kind of future, and if you want trade to participate in that future, then of course we would like to see trade to grow faster than GDP.
Thank you, Ralph. I only see Chris Horstman online. Chris, do you want to come back in, or is it a legacy hand? Otherwise, let me check. Anyone in the room?
One more in the chat.
Duke, do you want to come back in?
I have another question.
No, there's a-
Maya Plentz.
Yes, Maya, please go ahead.
Sorry.
Yes, thank you very much. My question is related to trade in services. You mentioned that it grew 9% in 2023 due to recovering travel and digital services. Can you break this down a little bit? Because when we talk about travel, the travel industry, we're talking also about quite a bit of digital services. And digital services, I understand, comprises not only e-commerce, but also other sorts of transactions that happen electronically. And then you expect growth further in 2024 due to exporting events. You mean the Olympics in Paris and easy visa restrictions? Can you also talk about that? And then okay, yeah, these are my questions related to trading services.
Thank you. Thank you for this question. So when we're talking about travel here in our trading services statistics, we reflect the balance of payment methodology. I want to clarify this because you mentioned tourism, and tourism much bigger coverage. Here, when the travel, so our growth rate of 38% and widespread growth globally and across regions, it reflects the traveler's expenditure during the stay in a foreign country. For example, for hotels, for restaurants, for entertaining, for sports events, or anything, any other services, but also for education and health. So these services are normally consumed in person. So these are, I see the director here, Shaolin from Trading Services. This is consumption abroad, technically, in our WTO terminology. So they are not consumed, the bulk of the service is consumed in presence by going to the country and attending concerts and so on. Of course, a part of a foreign and international traveler can also consume some digitally delivered services when he's staying abroad. It can follow like an audio tour through the internet and so on. But the value of this service is negligible from a statistical perspective and very hard to measure. So the numbers of digitally delivered that I provided and our estimates, they cover so-called mode 1. So those that are supplied at the distance between the service supplier and the service consumers. Among certain categories of other business services, there are also some like travel agency kind of services that can be provided remotely. So that, but we are not able to break down to this level of granularity to look at this very, very specific business services. So sorry for being long, but I think we needed to clarify to what it means, what there is in this 38%. So that is something. And then, okay, so
And you're
you mentioned the
factoring
easing of restrictions, so that are also in the report. in the report, we have seen that there are a number of countries in the world that have taken the initiative to have some visa-free schemes. Very recently, China is introduced for some selected countries some visa-free entry. And this is already starting to produce some good results, as effectively in the first 2 months of the year, the number of outbound Chinese travelers has increased, is almost reaching pre-pandemic levels, and also attracting foreign tourists to China. So this is only one example, but there are also other regions, like in the GCC countries, that also introduced they're trying to boost tourism, to boost international travel, and so they're opening up. So that's why the good prospect for the year together with all these major sporting events. Thank you.
Thank
Sorry
you.
for being long.
No worries. Thank you, Barbara. I don't see any other hands up. Maybe we'll end with a written question that I have just received. Ralph, the analysis indicated that in the next 2 years, trade volume growth will be significantly influenced by Asia. Which country do you anticipate will account for the majority of this volume? And what factors do you think would spur the growth, particularly in the region? This is from Business World.
Yeah, thank you very much for the question. So first of all, I would like to emphasize that even this year, but particularly next year, the trade growth is really broad-based. So the situation improves, I think, in all, or at least most regions in the world. Having said this, it is true that a particular impulse is coming from Asia, particularly this year. So I think I mentioned this in my opening remarks, but Asia this year is expected to add around 1.3 percentage points to global export growth and even 1.9 percentage points to global import growth. So it will indeed be an important engine of trade growth. So that's Asia. Now, in terms of the country composition, and I mean, obviously, China is an important part of the region. India is an important part of the region. I don't know, Coleman, if you have any more details that we can share. Certainly not in the report.
I don't have the figures in my head, but last year trade volume, I believe, was also down in Japan and Korea and a number of countries in the region. So it was a broad-based decline in manufacturing. Part of it having to do with energy price spikes that were not as severe as in Europe, but still affected incomes and business revenues. And then also weak external demand in the rest of the world, in North America and Europe. So the gradual return of these recovery of declines in energy prices and recovery of external demand will spur, I hope, probably a broad-based decline in broad-based recovery in manufacturing, exporting countries' exports.
Thank you, Coleman. If there are no more questions in the room, we'll just leave it there for now. And we'll remain available if you have bilateral follow-ups in the next few hours. So I would like to end by thanking Ralph, Coleman, Barbara, and Jose for being here today, and thanking you for participating in this press conference. Of course, we remain available for any follow-up bilateral questions. Thank you.
Let me also thank, of course, the colleagues from IRD, from the Ismaila and his team, and all the statisticians and economists who worked on it, but particularly Coleman, who's taking the lead on this report here. Thank you.
Yeah, thank you. I also, since we're thanking, and I see here a few faces that need, few colleagues that really need a big thank for their really excellent work on the Global Services Trade Data Hub. And so I want to thank the team, Tino, Fabio, and all the others, and of course, Ying, Okarsh as well. But yeah, so thank you very much. It's great work. Thank you.
Yeah, I would second that. We had a lot. It was an expanded report this year, and we had a lot of contributors, including, of course, Ying and also Mark and Michael, and so we all put in long hours to bring this out.
Thank you.